All right, welcome back to the show. Today I've got my buddy Russell Nersesov, and hopefully I didn't butcher his last name there, but we've known each other for about, I think about 5 years, and just had the pleasure of going on his podcast a couple weeks ago. Russ, man, welcome to the show.
Good morning. Good morning, man. I appreciate having me. Good to be here.
Yeah. So give us a quick intro. Who are you? What are you doing right now? And then we'll kind of dive into your story and go from there.
Yeah, man, for sure. My name is Russell Nersesov. I am a managing partner of Safe Storage USA and Flex Park Partners. We are a private equity firm. We raise money to purchase and operate self-storage facilities and industrial small bay flex space. Recently got into flex, primarily since 2020 and 2021. We've been in self-storage industry. We'll go into, I'm sure, at some point why the pivot and why we made that decision. But basically, we own multiple facilities, primarily in Northeast. We have a portfolio, and we are actively looking to purchase some of the flex space industrial parks and the Southwest. Basically, we're looking at Florida, we're looking at Georgia, Tennessee, North Carolina, South Carolina. So that's where we're at, man.
It's awesome. It's awesome. So you said 2020. What were you doing before that?
Good question. For about 23 years, I've been practicing as a licensed chiropractor in New York. I have multiple facilities and always had my real estate license. I was always interested in real estate, but chiropractic was my life, and that's how I was making a living. Unfortunately, towards the end of my 23 years, I had multiple injury to my shoulders due to the physical nature of work that I was involved with. And I had a dilemma. Either I had to have 2 surgeries or I would have to find another way to make a living. And to be honest, I came to the point where I said to myself, I've been doing it for so long. It's time for something else. I always had my eye on real estate, primarily, like most of us was watching. I'm sure I started in the single family rehab and fix and flips and whatever, and then that slowly progressed into land acquisition and land development, small commercial and conceptual development. I've done a lot of that. And sometimes around 2018, I got involved in multifamily. I joined a very prominent gentleman out of Texas, Dallas-Fort Worth, Texas, and I joined the mastermind. And I got to learn about investing in multifamily, larger apartment complexes. 100, 150, 200 units, and I learned a lot. But there was a time where multifamily was going up vertically. The appreciation was insane, and everybody was trying to get into multifamily. And naturally, I got involved into it and invested in a few projects passively. Learned a lot and realized that multifamily was at the peak, and there was not much left there for me to do except purchase overpriced properties and hoping someone else will buy it from me down the road 2, 3, 4, 5 years and would be willing to pay more money for it. So basically, there was no investment thesis. It was only I felt it was like a game of musical chairs. Who's going to be the last one sitting? So I decided that I'm not going to pursue that. I made some money doing the project that I was involved with, but I gathered a lot of knowledge and a lot of I grew my network because that mastermind had a couple of thousand people in it. So I met a lot of people, a lot of investors, a lot of people similar to me in the same position, looking to change their careers and whatnot. So had a lot of knowledge, and I was looking for an opportunity to deploy that in another asset where it was not on everybody's radar just yet. Yet there was a lot of opportunity, and God gave me, God put me on a path of self-storage. I started learning about it. I think I got it from YouTube videos that I'm passionately watching almost daily. I'm learning a lot from YouTube and from investors like yourself, John. And there was something about self-storage, so I started digging into it more and more and more and more, and eventually it led me to Mike Wagner, our good friend Mike Wagner, and his mastermind, Storage Rebel, um, which is where I met you and a whole bunch of other guys. And that was in 2020, I believe, the end of 2020. So from that point on, it was, I joined a few other mastermind because I feel that, every few years I want to change. I want to be exposed to different group of people, different investment criteria, investment mentality. I love Michael Wagner's mastermind. It gave me initial push and it gave me initial information. My first deal actually came from the mastermind, and I'm eternally grateful for it. And it was our first deal. It was very successful for us, partially because of the timing where we purchased the property and when we sold the property, and partially because of the size of the property. It was quite large. It was 42,000 square feet, mixed air, non-climate and climate, as well as about 27,000 of a covered parking space. So it was a very large deal, considered to be a large deal for the first deal that we made. And, the rest is history. We just kept buying more properties. And for about 3 years, we kept purchasing property, going direct to the seller. I'm yet to buy a property on the market property. And we'll go into the reasons why if you want later on. But we got a lot of success from going directly to the seller, making phone calls, looking on Google, and just trying to reach out and trying to get in touch with the decision maker. And we purchased 6 deals in the span of 3 years. Awesome. And should have done more. Looking back, looking back, should have done. Should have done more, of course, because what we consider to be a marginal deal 5 years ago would be a phenomenal deal today. Yep. But listen, being as a Maine, we all have 2020 looking backward. We had an opportunity in the last 2 years, my partner and I. By the way, everything that I do with my partner, David Kansas. So we had an opportunity to dispose of 4 assets within the last 2 years. And once again, we had a runway, enough time to do our value add plan, to raise the NOI, to modernize the property, to do whatever we have to do to make the property a lot more efficient and a lot more profitable. And then we had people unsolicited and sometimes solicited, coming into us and making us offers. And some of those offers, fortunately or unfortunately, were the one that we could not refuse. So we sold a whole bunch of properties within the last 2 years, and we are in an active mode right now to looking to acquire more. But I guess at some point we'll go into how difficult it is today in today's market to scale up and to acquire a number of properties. I mean, you can get lucky with 1 or 2, but if you really want to scale up, it requires a different approach. But I'm sure at some point in time we'll talk about that.
Yeah. So I want to go back to where you made your pivot from being a chiropractor to real estate. You said something that obviously you had physical limitations and you were either going to have surgery so that you could continue to be a chiropractor, or pivot and go to real estate. You pivoted, went into real estate. Why is that? Why do you think you did that as opposed to, because my guess is there's a lot of people that have been in a similar boat, or maybe they didn't have something happen like that, but they've been on the sidelines forever. They like real estate. They like the idea of it, but nothing has happened to them, or maybe something has happened to them that's similar, but they decide to have the surgery or something similar and stayed with their current path. Why do you think you changed? Because that's not an easy thing to do.
No, it's not. But I think it's very personal. I was never afraid of taking a chance. I was never afraid to to change, and that was a quite a drastic change, actually.
Yeah.
But when you're against the wall and when you kind of have to perform, I think that's why I perform my best, uh, because something had to happen, something had to change for me to, don't forget, I have a beautiful wife, I have beautiful two kids, and both of those kids are either were in college or just about to go to college. So the typical American dream, you own your house, you have a mortgage, you have kids going to college, you got to pay for that. So there was not a plan B where
Mm.
I could fall off on a leaf on my retirement funds. I was not there at that point. Something had to happen, and another thing that I have is I believe in my ability to pick and choose the uh, a right direction. It might not be necessarily a right thing immediately, or might not be apparent right away. But I have this ability to kind of feel that this is where I need to go. So I kind of felt that the real estate, and just like I said before, I always had a license. I always been involved in real estate, so I could see the power of real estate and what it could do to your financial future and whatnot. So it was kind of an easy choice because there was nothing else that I knew at that time.
Mm.
It's not like I had a different skill set that I could just go in and apply and get another job or buy another business. It would just either continue to what I was doing or get into real estate. But once again, not get into because I was into it already. You just get in full time.
Yep. Yep.
So I had an opportunity. I had support of my family. I had financial whereabouts to take some time off and dedicate myself fully to, first of all, learning everything about the asset that I liked. And that's when I joined the mastermind and building a network and building my team. As you and I know very well, this is a team sport. You can't do it by yourself. You need other people in your life helping you, guiding you, supporting you. So it was honestly, it was not complicated transition for me. It was kind of easy, and I was guided right into it, and I just went for it.
No,
I
it's
just went
awesome.
for it.
Yeah. Well, and I think, and I want to, this kind of parlays into my next question, but it seems like your decisions, your bigger decisions like that are very strategic. It's not like it's just on a whim. Let's try this. Let's see what happens. And just you
Right.
dive head first. It's more strategic. And that parlays into what you're doing now because you're pivoting again, right? You were in single family. Well, you're a chiropractor, single family, self storage. Now you're pivoting to flex. Why the pivots? Why not stay in an asset class? I don't want to say forever, but a longer period of time.
Great question, man. Great question. So my rationale, and when I'm saying mine, I'm talking about my partner and I. Our rationale for pivoting. Now, we're not abandoning self storage by any means. I believe the self storage business model is the best model and the most efficient model, the easiest to manage out of all commercial real estate assets.
Mhm.
And we've seen the power of self storage. We've seen what a incremental $2-3 every quarter increase in tenants rate can do to overall performance of the property. What can it do? What can it do to the NOI and therefore increasing the value of the property? I think it's one of the most powerful models out there. Probably very similar to the hotel and hospitality business, where they can adjust the rates multiple times a day. We don't do it multiple times a day, but we do it pretty frequently based upon the market supply, demand, and conditions. So, I personally, I love self storage. I love the model, and I wish I could buy a lot more of it in today's market. Unfortunately, the market has changed. The market is totally different right now, and besides the fact that interest rates went up and doubled within the last 3 years, um, there are other factors that I believe change the industry quite a bit. It's no longer a fragmented industry that it was when you and I entered the space. I know you came in 2018, a couple of years prior to me. I started in 2020, but if you remember back in the days, we were told that it's a mom and pop mostly owned business.
Yep.
industry. It's mom and pop. They don't know the value of their asset that they're sitting on. They are happy to get the check at the end of the month. They never raise rents. The property is performing, but financially underperforming, and that's where we had an opportunity to come in, to modernize, to introduce the marketing, introduce SEO, introduce management software, and introduce rate management, dynamic pricing, and those property would blow up in value, and NOI would go up, and it probably still the case, but it's a lot less so in my experience. I believe the consolidation efforts taking place in the industry right now will only accelerate, will only continue, and the big guy is gonna get bigger, and the big guy is gonna gobble up as many properties as they can. But one thing that changed is that the big guys I'm talking about, the privately held REITs and private equity, large private equity companies, they're not afraid to go downstream anymore. They're not afraid they used to stay away from tertiary markets.
Mm-hmm.
They would only invest in the primary markets. They had a very strict criteria, maybe it's very strong secondary market. But let me tell you, they're not afraid to go into a very, very solid tertiary market, which is where we operate. And the best example of it is one of the properties that we sold. We sold to a very large private equity company. I'm not going to name names, but they are many very, very, very large company, and they went into a tertiary market, and they were trying to buy as many properties around us as they could. So, can you compete with them? That's the question. Because I don't want to compete where I can't win. I want to compete where I have an opportunity to win. But can you really compete with the larger groups where the cost of funds supposedly is significantly less than ours? Their ability to finance properties is significantly better than we have. There's a multitude of reasons why it's becoming more difficult to secure the deal and to take down the deal, and because I don't think we are no longer in the mom and pop owned industry. I'm not going to quote exact percentage, but I think back in the days it was like 25% or 30% owned by REITs and 65, 75% owned by mom and pop. When I'm saying mom and pop, it's basically a business owner that owns one or two facilities, or maybe three facilities, but no more than that. I believe nowadays the percentage flipped. It's no longer 25 to 30% REITs. I think it's a lot more, probably half, if not more, and that acceleration happens very, very, very fast. Which brings me to a point. We're already in the industry. We already have the team. We're totally running the business by ourselves. We don't go to a third party. We have a management company within the office, and everything from A to Z, a calling center, the management company, and acquisition, disposition, and everything else we do from the office. So we already have all the tools in place, and we faced with 2 years of not being able to buy a property. And it's kind of difficult, because the machine needs to work, and I'm sure you can relate to this, but when you're not growing, you feel like you're dying, and it's just not a lot of fun. The fun is to grow. Because I felt about 4 or 5 years ago that the upside is unlimited, and you can accumulate as many properties as you want, and you can build as large of a portfolio as you want, and then you start dreaming of really big things, and it becomes part of your DNA. So I still want to do that. I just feel that this is a lot more difficult time right now to do that within the self-storage industry. And I'm sure some people are continue to buy properties and grow and whatever, but the way we planned and the plan that we had for ourselves in terms of the growth and in terms of the expansions are, we could not basically could not do it. So once again, all the knowledge, all the expertise, all the team, everything is in place. What do we do next? Where can we go next? Then I came about a year and a half ago, came into a flex space webinar, I think it was. And everything starts on YouTube. Everything starts online nowadays. So, and it kind of piqued my interest because it's similar, yet it's different. Mm-hmm. But the premise is very similar. The management is a lot more intensive, but it's similar. The development, the construction is it's different, but it's very similar. So it was kind of like a next level evolution of a self-storage. We actually, one of our properties in Maine, we have what we call a contractor units. They are larger units. We had I believe it's 16 by 30 with 14 feet high door, and we're doing very well with those units. Those units are always occupied. We never have issue with tenants because a lot of those tenants are businesses. So that was kind of like a telltale sign for us. We start learning about industry, start meeting people within the industry, and started to understand what this is all about. And I was hoping, I was telling my partners, I was hoping that we have 3-5 years runway before flex space becomes storage, meaning where everybody knows about the industry, knows how lucrative it could be, how scalable it is. And I said to my partners, we got to move fast because we probably have 2, 3, 4, 5 years the most. That did not happen. Partially we're to blame because we were talking about it everywhere on every podcast, and LinkedIn helped. But what I see is basically a lot of people are getting into flex. A lot of people are switching assets, and it's becoming very, very fast the new asset to own. And whereas, it's funny, I'm talking to a lot of brokers on a daily basis. They said even a year or two ago, they were looking at the cap rate significantly higher. And nobody was very few people were looking into it, interested in the asset. Institutional money were not going after it at all. And all of a sudden things changed, and everybody's into it, and everybody wants to be part of it, and a lot of money being raised to go in. And I see the deals being taken down on a daily basis at very, very compressed cap rates. So yeah, it's still a great asset, but it's becoming very known assets in the industry. And I don't think we have a lot of time before, if it's not already the asset, to be frank. So, we're going after both. We're going after storage. We're going after flex. And because the idea is still to scale up, it's still to expand, it's still to grow. So we're looking for opportunities.
Yeah, no, it's awesome. So actually, I'm in a flex space right now. My this is a flex space. So flex space looks a lot. There's a lot of options with it, and I mean that's why it's called flex, right? But yeah, I mean technically this is I'm in a car complex, right? A lot of people just have cars here. They build them out. There's other ones where probably more of what you're talking about, where it's more contractors. There's an office space in the front, warehouse in the back. Right. But yeah, man, I don't know. Yeah, there's definitely a runway for flex. I don't know what that looks like, but there's so many different options that you can do with this, right? Like there are people here just in this development that it's a man cave for them. It's a big man cave. Now they've got, disposable income that they can do that. But yeah, it's I think there's a longer runway, but it's a cool asset class for sure. Wanted to ask, you raise money, from what I know. Obviously I don't, but I've seen a lot of people recently get in trouble. And obviously from 2010 to 2022, for at least 12, 13, 14 years-ish, somewhere in there, you could raise money, syndicate, and make deals work pretty easily because for the most part, real estate kept appreciating. That's not really the case right now, especially when interest rates just doubled over the past couple of years. So how's it work? How are you making it work? What pointers can you give us? And why do you see others kind of getting in trouble?
Another very good question, man. Well, rule number one, do no harm. Just like in medicine, do no harm. We are we never do deal for the sake of doing a deal.
Mm.
We never do deal for the sake of collecting fees. We are working for our investors. They are entrusting us their money, hard-earned money, and so our job is to make sure that money grow, and we can deliver for them because we work for them. That's our baseline. Meaning, we don't do marginal deals. We don't do bad deals because we feel we're under pressure. We have to perform. Um, One of the hardest things I think in our business is to say no to a deal.
Mm.
And once again, we all want to do more deals. We want to grow. We want to expand, and you kind of and you know that better than anyone. You can make your underwriting look amazing just by changing 2 or 3 cells.
Mm.
But once again, we go back to do no harm, and just we don't do deals just to do the deals. We want to make sure that the deals are profitable. We want to make sure the deals are able to achieve whatever we set up to achieve for that particular deal. Because just like you said, we do raise money, and a lot of money that we raise coming from friends and family and investors that we've dealt with many times. They have they put their trust in us, and we don't want to violate that trust in any way, shape, or form. So, in terms of people getting in trouble today, listen. Unfortunately, I've seen that in 2018, 19. That was my rest sign to get out of a multifamily because I saw how skinny those deals were,
Yeah.
how tight the deals were, and the sponsor would have to go to 80-20, 85-15, 90-10 just to do a deal that's a split between the GP and LP, limited partners and general partners, just to do a deal because I think they were making money on the front end where they would get paid for the fees, the acquisition fees. We don't want to do deals like that, and like you said previously, and like I said previously, with the deals still being priced at the level of 22, 23, 24, and the interest rate doubling, going from some of the deals that we had was like in the mid threes back in 21, 22, close to 4 and 23. And now we're looking at, probably to be safe, we're looking at 7%, maybe a quarter up or down or whatever. It depends on the lender, but let's say 7%. And it came down, by the way. It was a lot higher within the last 12 to 18 months. So we feel that the assets are priced high. The expectation, the pricing expectations. When you talk to brokers and they give you a price, and my first thing is like, can you just run me through that number and just explain to me how'd you arrive to that number? Because I can't. I just want to be able to understand where you're coming from. Mm-hmm. But yeah, you have larger groups. You have like I said before, they might have different cost of funds. There's always a magical 1031 people that have to deploy the money.
Yeah.
You talk to, I speak to a lot of brokers on a daily basis. They're like, well, we're looking for 1031 buyer. Well, I know why they're looking for 1031 because it's overpriced.
Yeah.
And sometimes you're in the position when you're going through the exchange when you have to close on the property. Otherwise, the exchange will not hold. And but that's not a lot of it. So I'm going to have a broker on my podcast in 2 days, and I had a very interesting conversation with him a couple of days ago, and I'm sure we're going to have a blast on Thursday as well. And he said a lot of properties that are on the market right now are just unsellable. Mm. So so going back to that, listen, we have network of investors who are on a standby. Actually, if I can take a minute, I'm going to tell you about the deal we just did. I might be interested to your audience. We have a portfolio in Maine, and we consider selling that portfolio because we're already in for about 2.5 years, close to 3 years. We had some offers, unsolicited, and some offers through the brokers, whatever. And then we said, hey, why don't we refinance the portfolio? Why don't we take out the money, let it run, let continue to cash flow? And so I called our bank and I said, hey, we have an offer on the table. And, if we close the deal, we're not going to be working together anymore. Or would you be open to giving us a second loan um, behind the first one that we already have with you on the same terms and conditions, except the interest rate, of course, because it went up quite a bit. And so instead of refinancing the full amount at 7% plus, we were able to secure a second loan at 7.25%, but our first loan is at mid fours. So combined, we are at
it's a B note, right?
Correct, in low sixes right now. So the point that I'm trying to make is that we were able to return all the capital to our investors, all of it, 100%. We were able to return more money because we actually pulled out more money than we borrow. Not than we borrow, but then our equity was. We pulled out more money. We gave them more money back, and the property still continues to cash flow. So the same investors are like, guys, we love it. I mean, what's next?
Yeah.
Where do I put my money next? Keep my money. Don't give it back to me. Just keep it. Let's just go. Let's do more deals. And unfortunately, we have to be careful. We need to, number one, we need to return the money to investors. And number two, we said, hey, just be on the standby. We're looking at deals. We have a number of LOIs out. As soon as we close, we're going to be able to deploy your money. But the point is, they were very eager to continue because they see the potential. Unfortunately, not every deal is like that. I would say very few deals are like that. And but that's why I guess that's why we're looking, and that's why it takes us a little bit to find the next deal.
Yeah. No, I'm with you. And you made some really good points, and I wrote some of them down. Fees are a big thing, right? With syndicators, there are a lot of shops that, when I say shops, real estate owners, investors, that they're keeping the doors open. They're paying their employees through fees, just taking down deals. So there are deals where they may get into that don't cash flow, but they're doing the deals because they get some money up front from the fees. There's all types of fees. I've heard of some. I'm not a syndicator, but there's construction fees, management fees, referral. There's all kinds of fees that they get paid on, then they pay their employees and themselves.
That's correct.
Yeah. So that's one. Another one is short-term money, I think, is a big thing. A lot of people got unlucky too, and some people got lucky, right? But a lot of people signed up for short-term money thinking money was going to be there, or interest rates were going to be low forever, which they're not. Again, they doubled in the last couple of years, but I think a lot of people thought rates were going to kind of stay in the same spot. A lot of people got interest only. And when those things balloon 2 or 3 years and interest rates have doubled, deals just don't work. And I think too, and again, luck is definitely some of it, but I think, and as you were talking, it just hit me, this analogy is I think most real estate investors saw just after COVID, right? Like probably late 2000, early 2021. Yeah, early 2020, or late 2020, early 2021. Us as real estate investors saw a lot of opportunities, right? Yeah. And we all started running towards everything. Some of us started slowing down and stopped sprinting, and we're kind of jogging, and it was like, deals aren't making sense. I see things going on in the environment that don't look great. And some people kept sprinting. And I think those are the people that got in trouble or are getting in trouble because they just kept sprinting, and they just figured, you know what, real estate will turn around at some point. They're hoping for whatever new administration as president, whatever their excuses, but they just kept running. I think some of us, like you and I, kind of slowed down and looked around, was like, things are changing a little bit. I got to kind of change my underwriting as well. So yeah, all good stuff, man.
Yeah, for sure, man. For sure. What's
we know you're getting in flex space, but 5-10 years from now, where do you see yourself?
Wow. 5-10 years from now. So 5-10 years from now, I'll be 60 or 65.
Crazy to think about, huh?
I know. I'm old. I don't think that far. But honestly, we're doing a lot of other things right now as well. So if I can take a minute, I'll go through that. We are, well, let me ask you a different question, John. How do you feel about crypto?
Crypto?
Yeah.
I think, and I've got some buddies that are all in on it.
Right.
I think I think it's a good piece to diversify, but I don't think should be your main thing to invest in. Now, there are some people that make that work, but it's like a day trader, right? Like you really need to know what you're doing.
Okay. Okay. Fair enough. The
But hit
reason why
me.
I ask is
Sounds like you like crypto.
yeah,
Hit me.
no, I'll tell you. I'll tell you exactly what we're doing. So the reason why I ask is because what we started doing recently, we are adding additional layer of investment on top of the real estate investment. So let me explain. So the new PPM that we are working on right now will have Bitcoin layered on top of the investment in the real estate. Just without going into too many details, what we're going to do when we raise money, we're going to raise additional 10%. And that 10% of the additional equity, actually, we're raising 10% of the purchase price. And that additional equity will go into purchasing Bitcoin. And that will go into a long-term hold for us. So for as long as we're going to own the property, we're going to own the Bitcoin. And that the reason for it is I'm not going to go into crypto and Bitcoin, and it's the best performing asset since I'm not going to go into that. But where you're either in it or you're not in it. You either understand or you're not. You either like it or you don't. So we kind of want to work with people that are not only looking to invest in real estate but also looking to invest in crypto, because there's more and more investors like that. They love real estate. There's some that love real estate, don't want to touch crypto. There's some that love crypto, will never invest in real estate.
Yep.
We're looking for the hybrid. We're looking for the combination from somebody who likes the stability and cash flow of real estate with the asymmetrical return that potentially, and the key word is potentially, Bitcoin can generate for us over the long term. And so this is our latest and greatest. So the point being is, it's kind of a long-winded answer to your question, but 5-10 years from now, we want to continue own properties, and we want to accumulate a significant amount in Bitcoin. So I'm not saying crypto, I'm saying Bitcoin, because we're not investing in any other crypto other than Bitcoin. And that's a subject to different conversation. It's definitely a different conversation of why, but we're going to continue to use the real estate as a cash flow, as a means of generating additional cash flow and appreciation for that money to be invested in Bitcoin. And we are going to continue to use all the benefits of real estate, such as depreciation. And luckily, the new big BB bill, the bill which just passed, where the depreciation is back on the table at 100%. So we're going to continue to use that to accumulate, to buy properties, and to, we have another idea. Maybe we'll talk about it next time, because I don't want to take a lot of your time. But for now is accumulating real estate, accumulating Bitcoin, let it grow, let it do what it does. I really like that refinance opportunity that we just went through, because that was the first time where I realized that real estate is not, you buy it, you hold it, you sell it. Real estate, you buy it, you hold it, and you hold it, and you let it cash flow, you let it appreciate, because it needs time.
Yep.
It needs time. We all accustomed to, let's hold it for 5 years. We're going to underwrite for 5 years. Why 5 years? Just because that's the term of the loan.
Yep.
But what if you can hold it longer and it cash flow for you? Why sell it? Why deploy? I mean, there's other reasons but why you might want to consider selling. But basically, from this point on, we kind of want to use that refi till you die strategy, and use that money to purchase more Bitcoin, and just let it accumulate and make your money work twice as hard.
Yep. No, that's it's a great way to kind of start wrapping this up too. Is I do think real estate is meant to be held long term, and I think the whole concept of raising money, syndicating short term money, and then having to sell is relatively new. And while it can work, you have to have an appreciating market to do that. But the people that are holding on long-term are the ones that are creating true wealth. And not to go too far into this, but with self-storage and flex space, it's different than any other asset class because you have slow money and appreciation. You have medium money, which is, we can probably call that refis, right? And then you have cash flow because it acts like a business. So you have fast, medium, and slow money, which is kind of what I think the true, I won't say wealthy, but the people that are well off, that's what they have. They fill all three buckets, and self-storage and flex kind of fit all three of those.
Correct.
So yeah, I think you make a great point of holding, and it's a great strategy, obviously.
Yeah, if it works.
Yeah, man. Cool. Well, appreciate you coming on. This is absolutely awesome. Great information. If anyone wants to reach out, where can they find you?
I'm sure you're gonna list my email or some of the other ways to get in touch with me. The easiest way to get in touch with me is safestorageusa.com, safestorageinvestors.com, or find me on the X at Dr. Flex. I know it's a funny name, but that's the first thing that came to my mind when I wanted to come up with a name. And if you guys have any questions or whatever, you want to reach out and talk about anything we talked about today, by all means.
Yeah. Well, and you've got a podcast. What's your podcast?
Defining Your Niche. So it's Define Your Niche podcast. We're on twice a month, and we're talking about different things. We're talking about different industry, different niches, different approaches, not just the self-storage, but and flex. Very different things. So you can find us on YouTube on the Defining Your Niche podcast as well.
Awesome. Well, again, appreciate you coming on. Make sure you guys check out Russell's podcast. If you guys have any questions, reach out to him. And appreciate everyone for listening. See you next time.
Thanks for following, subscribing, and listening to this episode of the Do More podcast hosted by John Farling. To learn more or ask questions, go to l4investing.com.